Hello, everyone. Welcome to this webinar on climate change and corporate reporting and lobbying. It is a pleasure to host you here, to welcome you. We have organized this session with my colleagues from the Accounting and Finance subject group, Alvise, Favotto, and from the School of Social Sciences and Politics, Professor Kollman. And I am Professor Yannis Tsalavoutas from the Accounting and Finance subject group, excuse me. Since the COP26 starts today, it is a pleasure to have a group of expert speakers today to touch on the issues related to corporate reporting and lobbying. So I am going to chair the first session and introduce the speakers for our event. Just to introduce how the webinar will run. Okay. First of all, I want to outline a bit the lead that the University of Glasgow is taking in relation to climate change. In 2014, we became the first European university to commit to fully divesting from fossil fuel industry companies. In 2017, we endorsed the United Nations Social Development Goals, and we became the first university in Scotland to declare a climate change emergency in 2019. We published our Glasgow Green strategy on how to tackle climate change last year, and our target to achieve net zero carbon emissions is set for 2030. So we are taking the lead, and we are proud to bring our research in the forefront and inform practitioners, but also receive feedback from practice and companies, and that's the role of this event today. So in the first session, we will have two speakers. The first one, Aaron Pinnock, investment lead at the Church Commissioners for England. He is going to introduce his approach, the investors' approach to climate change, and the challenges that they are facing, and of course the opportunities that lie ahead. Aaron's talk will be followed by our colleagues Diogenis Baboukardos from the University of Essex, where Diogenis is going to present the findings of our ACCA-funded work on exploring the discussion of climate change risks in extractive companies' annual reports. And then, of course, we will have a Q&A session where attendees are more than welcome to share their questions in the chat, and we will discuss and provide answers. Then at 10:30, we will have our second session for today, where Geoff Mackey from BASF, Corporate Affairs and Sustainability Director of BASF, excuse me, he is going to share the carbon management challenges that companies face, with particular focus on BASF and their experience. So we will hear the company's point of view. And that will take us on to the third session, where we will debate and hear about the lobbying activities that are taking place around the area of sustainability and climate change reporting, starting with Alberto Alemanno, Jean Monnet Professor in European Law and Policy from Paris, HEC Paris, where he will talk about taming corporate political activity. And the last but not least presentation for today from Alvise, Favotto, colleague, as I said, from the subject group here in Glasgow, who will be sharing the findings of a Leverhulme-funded project on corporate lobbying on climate change, and whether CSR lead to greater political responsibility. As in the case of the first session, both the second and third sessions will have Q&A. We will allocate quite a lot of time for Q&A. So presentations are intended to be relatively short for giving the opportunity to people to share their views and questions. So that's a brief introduction on the session. And now I will thank you for joining us, and I will say enjoy the talks and debates. And I will very briefly introduce our first speaker for today, Aaron Pinnock. Thanks, Aaron, for joining us. Aaron holds a Bachelor of Science in Economic History from London School of Economics and Political Science. And he is also a CFA holder. He has experience as commodities analyst, and then he went on and he was senior investment associate in one of the big four firms. And for about 3 years, I understand now, he is impact investment analyst in the Church Commissioners for England. So again, thank you for joining, Aaron. And then Diogenis. Diogenis is a senior lecturer in accounting at the University of Essex. His main expertise and research is on sustainability reporting and integrated reporting. And he has published widely in the area, and he has teaching experience in the UK, in Sweden and Greece. And it is a pleasure to have Diogenis here with us today, sharing the findings of the research. So I will pass on to the two speakers. I will give you a heads up 2 or 3 minutes before your time is finishing, just to keep things on time, if you don't mind. And I will pass on first to Aaron to start with his talk. I will stop sharing my screen. Thank you very much.
Great, thank you for the introduction, Yannis. I'm just going to share, excuse me, my screen, and hopefully you can see that absolutely fine now.
Yes, it is fine, yeah.
Okay, great. So as Yannis said, I'm just going to give a 10-minute overview to set the scene, I guess, of how an investor approaches the challenges of climate change, and particularly relevant to this crucial work that has been developed by the University of Glasgow and University of Essex. So I'll just touch briefly on who the Church Commissioners are. So we're the endowment fund of the Church of England. We're the second largest charitable endowment in the UK, with about £9 billion sterling in assets under management. And even though we are a faith-based investor, I think it's important to say that we do seek market rate returns. So we liken ourselves to a normal pension fund or something like that. And it's important, especially in the context of climate change, to say that we have, as an endowment of the Church of England, our time frame is perpetual. So climate change is kind of the #1 risk that we see over the long term. So ethical considerations in ESG, as you'd expect from an institution like ours, is at the heart of our approach. We have, at the beginning of last year, we formally adopted a 2050 net zero commitment, and we do that as part of the UN convened Net Zero Asset Owners Alliance. And we're also a supporter of the TCFD, so we report kind of in line with their requirements, and encourage our investee companies and managers to do the same. And then a few years ago, we also worked with the LSE to co-found the Transition Path Initiative, which helps us identify high fossil fuel biased companies that looking to see their transition plans to align themselves with Paris, and that's a key way that we look at the kind of risk and alignment of companies. And then just on the right there is our breakdown of our asset allocation. We're quite diversified, as you see, and it's important, I think, in this context, public equities, which is the focus of the work here, it counts to about 45% of our endowment. So a meaningful and significant part of it. So it's just, I mean, I don't think I need to describe why climate change is an issue to anyone attending or listening to this call. But from an investment point of view, it's important to base it not just in the ethical element, but also in the financial importance. So we are explicit in our responsible investment policy that we see climate change as the single most important factor that will affect our long-term financial returns. And it's important there, we say single most important factor across the board, rather than single most important responsible investment factor. Climate change is the thing that we concentrate on more than any other ESG risk, so environmental or social or governance risk. That said, of course, the social side of it and the governance side of it is important, but as a long-term investor, financially important, this is how we see it. And it's important to say that it's not an issue that we can diversify away from. So a lot of risks as investors, you can tilt your portfolio away from that specific risk. If you see the UK, if you don't think the UK is going to perform well from an investment perspective, for example, then you can tilt your portfolio a bit more to European stocks. This is not the case with climate change. Climate change is, as I'm sure I don't need to explain here, you know, it's an issue that will affect the global economy, both from a transitional point of view and a physical point of view. And then just the graph at the bottom here is how we justify our action towards climate change from a financial perspective. Now, the one thing I can say about this graph at the bottom is that it will be wrong, but it offers a good analysis and forward-looking kind of assumption on how climate change will affect our portfolio. And this is done through modelling the transition risks that our portfolio face using some models that the IPCC also uses, and then also looking at the potential physical risk that is due to our portfolio. And it's important to note that this is only out to 2035. So you may expect the 3-degree no additional action to be much more impactful from a negative perspective on our portfolio, but this is only up to 2035, so in only 15 years. And so you're not having the full physical effects of climate change run through the portfolio by that point. So how do we approach climate change? Well, the first one is as a risk mitigation. So as I mentioned, we see climate change as the single most important factor to the downside of financial returns to our portfolio. So we encourage our investment managers and our investment companies to report in a consistent way. And at the moment, that's in line with TCFD recommendations, or if another framework emerges, then we encourage that. And we expect it from a governance perspective, look at their transition plans and their ambition, and then reporting, because that's where the rubber hits the road, and we need to report that. And then in line with that, we have our 2050 net zero commitment, which we expect to help kind of mitigate some of that risk. And as part of that, you know, we're engaged with the kind of international community of asset owners, companies, policymakers, etc., because that's how we see the risks that can best be managed. It's a systemic endemic risk that throughout our portfolio. And so we have a 2025 interim decarbonisation goal. And then where we invest with companies or into companies and with managers that maybe don't have the best climate disclosures or aren't transitioning appropriately, then we will engage with them. And two examples of those are recent examples are Exxon and KEPCO. So Exxon, we were part of the engine number 1 activist scheme to replace some of the boards with more climate friendly or energy transition friendly board members. So that's a pretty innovative case of engagement with companies. And then KEPCO is another interesting one. They're a South Korean steel producer. And we were able to persuade them by kind of lobbying the South Korean government, who had recently at the time put in their own net zero goal, to not expand their coal-fired power plants to produce their steel. So that was another interesting one. Investment in climate solutions, we invest into climate solutions. We've got about £600 million into such investments. And then advocacy with policymakers. So we're part of the deforestation in Indonesia scheme with the IPTD. We advocate for carbon price, and we see that as kind of the single most one of the most effective signals to be able to invest appropriately in this area. And then, so my last slide, which kind of sets the scene, I think, for all of this, is the single most important thing to us as investors is that inadequate reporting on climate change will lead and does lead to poor investment decisions. And then if you look at the 4 bullet points that I outlined there, we require adequate disclosure from our companies to be able to assess their future risks. And at the moment, frankly, that doesn't really exist. So less than 20% of the MSCI ACWI, and that is an index of about 10,000 companies across the world. So kind of the biggest listed equity companies across the world. Less than 20% report Scope 3 emissions. Physical location data is extremely difficult to obtain. It's not reported consistently, and especially in the extractive industries, that's kind of where the big risk lies. Net zero commitments ambitions, they're heterogeneous, they're very difficult to kind of compare and contrast. And similarly, where climate risk is addressed in corporate disclosure, which is not often the case, these approaches differ substantially. So actually, from a responsible investment point of view, we have to sift through so much noise and inconsistent approaches, even where it does exist, which means that these challenges mean that we cannot really appropriately assess companies. So better disclosure is kind of the one key ask that we have of companies to be able to manage our risk effectively from both a moral perspective, but also a financial perspective. And I'll stop there and pass on. But, so that's just setting the scene for how an investor like us approaches climate change. So thank you very much.
Thank you very much, Aaron. Let's don't take questions at this stage. Let's pass on to Diogenis, and then we will have our Q&A. Thanks.
Thanks very much, Yannis. Allow me to share my screen first. Can you please confirm that you can see my screen?
Yes, fine.
Okay, excellent. Thanks a lot. Thanks everybody to join, and thanks a lot, primarily University of Glasgow, for organizing this webinar. I'm very happy presenting the findings of 2 research projects that we have conducted recently, both of them supported by ACCA and Adam Smith Observatory for Corporate Reporting Practices. In both these reports, in both these projects, a team of excellent colleagues from various universities in the UK are involved. Dionisiou from University of Stirling, Richard Slack from Durham, Yannis Tsalavoutas from Glasgow, of course, and Fanis Tsoligas from the University of Bath. The topic of climate change and the importance for the longevity of the planet, in fact, or of the humans, has been raised by many scientists for decades now, but it's only very recently that we see companies, even capital market authorities, and also national governments and supranational organizations taking a more important steps and real actions towards this direction. Of course, as Aaron also mentioned before, when it comes especially to investors, reporting is important. Of course, not only for investors, but for other stakeholders that they want to make their own decisions. But reporting plays a crucial role. Also, based on previous literature, we know that good and consistent reporting many times also leads to changes in the behavior of a company, which is also a desirable outcome in this case, considering that we want to restrict as much as possible the impact of climate change. Based on that, we see that recently a lot of the various organizations, starting from capital markets like authorities like the SEC, acknowledging that we do not have enough disclosures in relation to climate change in the US companies, but also actions that have been made, for instance, from European Union, providing specific guidelines within the European Union non-financial reporting directive about climate change. And even more recently, the announcement from the New Zealand government on mandatory adoption of the TCFD, but also UK which will be the first country out of the G20 countries to mandate the task force on climate-related financial disclosures for all listed companies from 2023 onwards. In this environment, we also see companies having recognized recently quite a large number of write-offs of their assets, and this graph comes from Thomson Reuters, where we see that more than $110 billion have been written off only in 2020 and the last quarter of 2019. To some extent, not only because, but to some extent because of climate change rendering their assets stranded, so not of any use. So they had to take this write-offs. Shell, as you can see, has recognized the most of them, but also other large corporations within the oil and gas industry, which is also a very important aspect of our research, playing this role. In this environment, our group, our team, conducted, as I said, two projects, both of them analyzing the climate change-related risks disclosures of large listed companies in the extractive industries. In fact, the largest based on their carbon emissions for the period 2016 and 2019. But we had also as a restriction in order to have a more comparable sample companies that they apply IFRS. So whatever I will present now, they do not refer to the US companies, in fact. Now, the 60 companies that we analyzed in 2019, out of the 60 companies, we could analyze only 56 companies for 2020 because our cutoff point was 1st of September, and we did not have annual reports available for 4 companies. The findings of the first report has been published back in early 2021, whereas the new report for the 2020 annual reports will be released in a few days within November 2021. Now, what we have analyzed is both the front end and the back end of the annual report. So both the more narrative, let's say, part of the annual report, but also the financial statements and relevant notes. And we covered a quite wide variety of different parts of the report, from the research center report and resources statement, scenario analysis, the business model of the company, whether the companies provide any key performance indicators in relation to climate change, but also whether they engage with the TCFD. When it comes to the back end, we focused primarily on the asset side of the balance sheet. We examined the accounting policies note and the assumptions that companies made, if they make any assumptions in relation to climate change. Then we moved to specific notes about impairment testing, non-current assets, and provisions. And also we reviewed the audit reports and whether the auditors identify climate change as a key audit matter of their audit. Now, if we see the big picture of what we have found is that, as you can see in the dark colored column, the front end of the annual reports in both years, both in 2019 and 2020, the companies provide way more information, at least based on our research instrument, than they provide in the back end. Also, interestingly, we see a quite substantial increase in the disclosures in 2020 in the front end, whereas for the back end, we see only a marginal improvement from 24 to 27%. If we zoom in and we take a look at the disclosures by region, we see that the companies in Europe engage way more than other companies in other parts of the world with this type of disclosures, both in the front and the back end. Whereas another interesting finding is that the relatively small sample of African companies, we have only 3 African companies in our sample, they also exhibit quite large disclosure levels. One reason, potential reason for this interesting finding about African companies is that these African companies come from South Africa, and in South Africa, companies are mandated to engage with integrated reporting, which maybe they have an extra incentive or an extra pressure, let's say, reporting on climate change. Now, moving to more specific items within the front end of the annual report. One finding that we believe it's quite interesting is the number of companies engaging with a specific explicit discussion about their business model. And as we can see, of course, it is quite large number, 50 out of the 56, but still there are some companies that they have yet to report on their business model. More specifically, when it comes to climate change, we see that 44 out of these 50 companies, they identify addressing climate change risks as an integral part of their business model. And also half of these 44, they consider specific international initiatives, primarily, of course, the Paris Agreement, in the discussion of their business model. As we can see also, these, what I just described are the findings from 2020. The light-colored columns refer to 2019, and as you can see, the numbers are smaller, which means that we are witnessing an upward trend in the reporting of companies, at least in their business model. Another, we believe, important finding of our study refers to key performance indicators. We can see that even in 2019, the largest part of our sample, 84%, they do provide some key performance indicators in relation to climate change. Primarily, they report their carbon emissions, and I would just agree with Aaron in this case that, of course, scope 3 emissions are usually absent. They do not report on scope 3. And in fact, only a few companies, they even report on scope 2, whereas the most of them, they just report their total emissions. Now, out of these 47 companies that they engage with these disclosures, we see a quite interesting finding that a few of them, they do what we call a full or a partial integration, in the sense that they provide some type of financial information together with their climate change disclosures. By partial integration here, we mean that we see that the climate change disclosures are presented on the very same page with some type of financial reporting, some type of financial ratios primarily. And by full integration, we mean that they integrate some financial information with climate change information. And in that sense, primarily we find that they provide information about their carbon intensity, measured as a ratio of their total sales to their total emissions, or basically total emissions to their total sales. I'm sorry. In 2020, the picture is better again. We see even more companies engaging with this type of disclosures overall, but also we see a quite interesting upward trend in the partial integration. So we have more companies providing on the very same page both financial and climate change related information. Finally, about the front end, we also see an upward trend on the TCFD. Companies in 2020 engage much more with TCFD than they did in 2019. And we might also expect that this upward trend will continue, considering that we have countries that they mandate TCFD, and that will also have probably an effect in other regions as well. Now, moving to the back end, as you can see, of course, the numbers now are much smaller than before. And by focusing on the impairment testing assumptions that the companies made, we see that in 2019, we had only 10 companies identifying climate change as part of their assumptions, whereas 17, which is quite a substantial increase, we find in 2020. A specific example, a good example basically of such disclosure is found from OMV, where they clearly state that we acknowledge that the short and long-term effects on climate-related matters and energy transition will have an impact on significant accounting estimates. And if we read through this text, which of course we will not do due to time restrictions, we can find, especially at the bottom of this slide, that they provide also more specific numerical information about the assumptions that they made about the Brent oil price and so on. Relative to that, we have also the impairment losses recognized by companies in the cases that they do acknowledge the importance. They recognize that climate change played a role, and in that case, we see that there are very few companies that they recognize impairment losses, and they acknowledge that climate change was at least one of the factors that led to this impairment losses. One of them is Repsol, which explicitly states that we have an accelerating pace of the decarbonization of the economy, and hence, in order to achieve the climate change objectives of Paris Agreement, we have to recognize these losses. Another important aspect, as I mentioned before, is related to what the auditors do, we believe. And we also see the auditors becoming more interested in issues in relation to climate change. In 2019, 8 out of the 56 companies, they had their auditors identifying climate change as a key audit matter, whereas in 2020, this number increased to 13. And this is an example from Glencore and Deloitte, where Deloitte clearly states and basically discuss quite extensively the impact of climate change on companies' assumptions, scenarios, and so on. Now, the final 2 aspects that I would like to bring in this discussion, first of all, is a couple of examples in relation to how some companies connect or try to connect the front to the back end of the annual report in relation to climate change. And here is an example from a KPI, as I described before. EVRAS does provide information on carbon intensity. If you see on the right-hand side of this graph, you will see that this ratio presented there is basically what I just described before, the relation between sales and emissions. The second example is from BP. BP on the front side, on the front end of its annual report, has an extensive discussion about their investment process, how they do the investment appraisal process. In this one, gives specific scenarios and specific information about the assumptions made for the Brent oil and the carbon price for a long window up to 2050. And this information flows to the back end, where when they discuss the price assumptions for their impairment testing, they do discuss that in relation to their investment appraisal. And to conclude, there are a couple of issues that we identified while we were analyzing these annual reports. We think that we need to consider further how we treat these issues. The first one is in relation with the capitalization of provisions. And in this case, what all companies do, all 56, or if you wish 60 from the first report companies in our sample, they do capitalize as they are expected from the accounting standard. They capitalize all the future decommissioning and restoration costs that they expect to have at the end of the useful life of their asset. Either we speak about an oil well, for instance, or a mine, or anything else, which is absolutely fine. And this is what they need to do in relation to the accounting standards that they follow. And this is a way to recognize this cost. However, some companies, in order to ensure that they will have the necessary cash flow in order to take these actions that they will expect, that will be expected to take actions at the end of the useful life of these assets, they have created funds, specific trusts, where basically they save money in order to be able to accommodate what they are expected to accommodate at the end of the period. And something that it would be probably, and I believe that the investors, and maybe Aaron can give us some insights on that, would appreciate if they want to take, when they take into consideration the risks in relation to climate change. Finally, and trying to be a bit more provocative maybe, I would say that climate change is good. And it's not that what I'm saying, but what some companies say, at least in the financial, in their financial statements. Companies that they operate in specific industries that they expect to have an increase in for the demand of their products, for instance, copper, they expect to have a good financial return, a good financial impact, but strictly financial impact that derives from the changes that they will make in the economy due to climate change. For instance, this company refers to the electrification of transportation system, to the increased demand for renewable energy, and so on. A question that, in my point of view, at least arises, is that by focusing only on this financial outcome, which indeed I do not. I'm not saying that it will not be positive. Do we really have the whole picture of what is going on? And if we really take into consideration other indirect financial impacts that the company might have, and that probably goes back also to what Aaron said earlier about investors, that even though they have an ethical approach as the Church of England, at the same time we can expect that they also need to have a financial return, and how that can be tackled. And for that, I will finish here, and I would like to thank you all for attending.
Thank you very much, Diogenis, for sharing the findings of the research and for your thoughts. There are a couple of questions in the chat, but before I share them with you, I would say just whether Aaron wants to comment on Diogenis' talk, or Diogenis may have a question to Aaron, whether you want to start the discussion like this, please. If not, I can share the questions from the chat, and I also have a couple of questions. So yeah, it's up to you.
I'd like to ask one for Diogenis, and that was really interesting. So thank you. I'm interested to hear a bit more about your findings on impairments and the lack of companies reporting on potential impairments in the future with a potential carbon price or stranded assets, whatever it may be. It's quite compelling that BP are one of the few that have an explicit carbon price kind of assumption in their accounting. And I'd be interested to hear what you hear, what you see trends from other companies doing similar and findings there.
Yeah, thanks a lot, Aaron, for the question. In fact, without naming bad examples, but about good examples, as you said, BP is one of these very good examples where the company indeed engages in a quite long and extensive description of how they take the climate change impact into consideration when they do their impairment testing. Other companies that they do that, they are primarily, I would say, European companies. We see, for instance, Total having a very good and high levels of disclosure in this aspect. Shell, as I said before. On the other hand, we have companies in other parts of the world that in many instances, and this is quite interesting to see the role also of governments or regulation overall, is that we find companies simply stating that we are operating in line with the law. The regulation does not impose any further actions from our side, which means that we do not expect to have any negative impact on our cash flows in the future, because we are not going to get any fine or anything like that, which to some extent, in my opinion at least, contradicts a bit the whole concept of tackling the climate change and energy, because the governments might take some steps, but usually they are quite slow in deciding and implementing new regulation. And I hope we can bring there will be a good agreement now in COP26. But the first messages, for instance, come that there will be even a more difficult debate than there was one in Paris in 2015. So I think that the companies, they also to some extent have to take their own actions without waiting the governments to take some actions. So I would say that companies, to come back to your question, that companies in specific parts of the world, that probably also the stakeholders are a bit more active and stronger, that we see that they engage more with this type of disclosures. They would provide information about as I said before, Brent oil prices, about potential litigation risks that they might be higher due to new regulation and so on. And we see much more informative, let's say, disclosures, whereas in other parts of the world this is quite alarming. And just to bring an example of maybe and surprising to some extent example is the case of Canadian companies that although Canada is well known for taking care of the environment and being quite active overall as a country, we see that the companies do not engage a lot with this type of disclosures. In fact, they have a quite low disclosure level, one of the lowest basically in our sample.
Thanks, Diogenis. I will start with, I don't know if Diogenis has a question for Aaron before I open to
yeah, thanks, Yannis, for that. I raised a couple of issues during my presentation, so if Aaron wants to answer now or later, I'm totally fine for that. But you know, especially in relation to the provisions and how we treat the climate change impact. But it's up to him if he wants now, or we can take it later.
Okay.
I can touch quickly on that. So I think your point on the physical risk and the locations, especially with regard to mining companies or extractives companies, is so important for us. We, in light of the Brumadinho tailings dam disaster that was 2 or 3 years ago now, that was a really key moral issue for us, because they didn't have the disclosure of where these tailing dams were, what the kind of impact of destruction of the livelihoods were that came from tailings dam collapsing. There wasn't really a kind of globalized database for where those dams and those risks are, which is it's that lack of disclosure which makes it very difficult as a responsible investor to invest in such companies. And so that's one example that's not directly linked to climate change. It's more of a kind of offshoot and a social problem, but it's exactly the same kind of issue that we will have a few years down the line, in that there isn't this physical asset location data. It's going to be so hard, especially in certain jurisdictions or areas where policy maybe isn't as advanced in other countries or areas. And I see that being a really big risk for us going forward, which just isn't adequately disclosed. So that's the key takeaway that I think I have from that.
Thank you, Aaron. Right, one question in the chat, that's for Aaron. To what extent do you see across the investment management sector your views on climate change risk actively shared by other fund managers?
Yeah, and Diogenis shared the slides with the companies that have adequate climate change disclosure by sector. And actually, I think in terms of fund managers and asset owners, those percentages and those trends are exactly the same almost. It really depends on where in the world you are. So Europeans and the Nordics especially are quite advanced on it. Australia is quite good, New Zealand, Europe, I think I mentioned. Where there are the laggards are Asia, although Japan is catching up, but the Middle East and China. And then America, which is the kind of, the behemoth that if they get this right, then it will start to emerge. We're seeing, I mean, you do have some American fund managers that are really hot on this and asset owners. So the Californian pension fund and the state pension fund and the teachers retirement fund there are really good. And I guess that's probably because of the jurisdiction that they're in. And we're starting to see more and more of our most sophisticated fund managers really get a hold of this topic. I think it's fair to say that when Americans, or maybe it's a generalization, but generally when you see America start to tackle a problem, they do it quite well if they get behind it. And we're certainly seeing that with some of our most sophisticated fund managers that 3 or 4 years ago when we were trying to engage with them on this topic, they were not interested. And now they start to realize the risks that are there, both from a transitional and a physical perspective. And the innovative approaches they're taking with big data and AI and being able to feed that into their fund process is really quite remarkable. So they can change a lot in a few years. But that is definitely our most sophisticated managers. And otherwise, it's kind of depending on what area in the world you are, depends on your kind of commitment to climate change.
Okay, thanks, Aaron. Just on that, the person who asked that question, he followed up saying, do you see investment managers actually, demand these disclosures? Is it publicly open that they demand these disclosures from firms, or is it something that happens, less aggressively? Let's put it that way.
Yeah, this is an interesting area that I think is emerging in investment, is being a bit more publicly, not aggressive, but demanding in what they want from their investee companies and the policymakers. I think it's fair to say that very few of our investment managers, and this probably applies across the board, are willing to take that demanding stance. Generally, investment managers, at least with our experience, they want to be a bit more guarded, a bit less kind of publicly demanding of these sorts of things. So they might do it behind closed doors, kind of one-on-one relationship, but it's very rare that they'll come out and demand those disclosures in public. I think because it can affect their kind of fundraising for future funds if they're deemed as too aggressive, or if an investment company simply doesn't want to engage with them. So there's a bit of a nuanced relationship between them, but I think there's emerging that, and we're certainly asking for it for our fund managers to be more demanding in what they want to see from companies and governments. And I think this is a big area.
Okay, thank you very much. Another question in the chat, which might be relevant to both of you, is whether XBRL services help climate disclosures by companies. Do you think that assists this type of disclosure or no?
Aaron, you want to take this, or?
I might leave that one to you if that's all right.
Okay, that's fine. Yeah. XBRL, it is a type of any type of, let's say, new technology can be of help and use for providing better reporting. In my opinion, though, the most important aspect of all is what the company really wants to do. Like, the technology might be there, but it's not so much a type of. I don't think that at least in the current situation, the issue is that we do not have the tools to disseminate or report the information. It's more important to know whether we can measure reliably the impact, and that is more important. And there, I think that other type of tools are needed. As Aaron mentioned earlier, for instance, we have very few companies reporting on their scope 3 emissions, but also there are different ways of reporting your scope 1 and scope 2 emissions. There are different standards. There are even different types of reporting, what it is called the dual reporting, the so-called region-based or market-based reporting. So I think that it is more important to find a more consistent and reliable way of measuring how much we harm environment and what is also the financial impact of that, than some new technologies that they are more related to how we communicate this.
Thanks, Diogenis. And in relation to that, actually, we have another question in the chat. The person says, I am curious about non-reporting of scope 3 emissions, which both of you touched on. Do you think this is a function of data measurement, or is it a strategic choice of firms in the sense that they like to push emissions down the supply chain from main operations? Don't know if Aaron wants to start with this answer, given you touched on scope 3 first. I don't know.
Yeah, sure. I'll touch on it quickly. And it's a great point. I think it's a bit of both. I think that some companies, especially in emerging market generally haven't really got their head around scope 1 and 2 emissions. And so scope 3 is kind of the next step and a bit further away. For others, I think in sectors where scope 3 emissions are, the bigger percentage, oil and gas is most obvious, and other consumer firms, then I think it is a strategic decision. And I think they're quite, you can see it when they just put in scope 1 and 2, intensity targets, which totally misses the point. And it's been a battle over the last couple of years to try and get that into reporting. And then the same issue is coming up in our private markets portfolio. So, public markets is probably the most important at the moment because they are the largest companies. But private markets is such a big area where there is no disclosure and there isn't really a common framework. And scope 1 and 2, a lot of our companies and several of our managers are only looking at scope 1 and 2. And I think that is because scope 3 is a conscious choice that they don't want to touch it, and they want to kind of push the burden onto someone else. And obviously that's wrong for a lot of reasons, but from a financial perspective as well, it's imperative that we have that scope 3 kind of look through for us as investors. Otherwise, again, we just don't have the overall view of the risk of that company because it will feed through, and that's the main issue for us.
Okay, thanks, Aaron. I don't know if Diogenis wants to say something, or it was covered as part of the previous, as the answer to the previous question.
I'm more or less covered by Aaron. I just to say that I think that indeed scope 3 is difficult to measure. So definitely companies, they do face difficulties on how to measure reliably that. At the same time, I think that the point that of the question that maybe the companies, they just want somehow to conceal this information is also part of the truth, considering that they can show they are quite out of their hands these emissions. With scope 1 and scope 2, they can more easily, not more easily, but they can have more control of what they are doing. But with scope 3, is quite difficult, and to some extent it reminds me like the shipping industry today reminds me also other cases of industries that they have moved their production in other parts of the world away from Western countries, where they again based on the supply chain issue, they might be involved in not so ethical operations. But they do not really have control over these operations. In my view, the truth is somewhere in between. On the one hand, we cannot really measure everything, but on the other hand, of course, that maybe also is a bit of advantageous for the companies themselves. The final point is that also that in many occasions that means that if we also take into consideration scope 3. Then this scope 3, they will be double, triple, and four time counted, right, from different companies. And then also there is this bigger problem of, do we really know how much we emit in a year as a planet? So yes, thanks for that.
Okay, thanks, Diogenis. And we are approaching the end of this session, so I will pick up one of the questions in the chat and amalgamate it a bit with what I had in mind for Aaron. Aaron, in your presentation, you mentioned, or you seem to indicate, that you rely on TCFD disclosures. And so the person in the chat asks whether, the UK government's announcement that they will mandate TCFD disclosures, whether this is something you see as beneficial. I would guess from your current focus, the answer is yes. But then there is the counter argument. We have so many different frameworks being around at the moment, and there is this debate about actually mandating non-financial reporting standards. So how do you stand on this variety of reporting frameworks, and whether actually companies, again, because you mentioned that you see inconsistencies in reporting, whether this is a result of the variety of frameworks, or whether the variety of frameworks has a negative impact on the disclosures that firms end up providing?
I think that the variety of frameworks definitely has a negative impact. I think probably the single biggest question that we get back from our investment managers and companies is, okay, we've got hundreds of KPIs that different people, different investors want us to fill out, and we don't know, and really kind of is largely pointless. What becomes much more impactful is when they take a step back, and this is really the most advanced companies, and say, okay, what do you actually want to find out? Let's just talk in layman's terms and say, okay, what is it actually that you want to find out? And then usually the KPIs that investors or whoever are requesting aren't actually usually the most kind of beneficial to answer that question. And this is where I think the reporting frameworks get in a muddle, and it's going to be difficult. And it's where you need one. You do need one standard. And TCFD isn't the perfect thing, because it does allow a lot. It's just a framework. It allows a lot of kind of differentiated approaches in there. But at least you do have some semblance of normality in that framework. But it is an issue, especially with the metrics and targets piece. That is the reason why we work on the Transition Pathway Initiative, because it's something that tries to scroll through all these differentiated reports and put them into kind of one comparable, a lot of disclosure. The one thing that I've heard said a lot in the impact space, and I think this is true, is that, and especially probably preaching to the converted here, but it took however many years, decades to get IFRS and GAAP accounting, and climate change reporting, I guess, is going through that process now. So I expect it will come, but at the moment it is quite difficult.
Okay, thank you very much, Aaron. I would like to thank you both for your contributions. In the interest of time, we will stop here. We will switch off cameras and microphones. So we'll have a very short break, and then 10:30, my colleague Kelly Kollman will start the second session of the day. Again, many thanks for your presentations, for sharing your views. I hope attendees found it useful. It was certainly very interesting for me, and I believe it was for others. So again, thank you for your time and your contributions. Okay, so we'll switch off cameras and microphones, and then in 3 minutes time, we can start the second session. Thank you very much.
Thank you.
Hi, everyone. Welcome to our second panel. My name is Kelly Kollman, and I am one of the roundtable organizers for today and a member of the Politics and International Relations subject area here at the university. So as I said, welcome to our second panel of the roundtable. With our first panel focused on corporate reporting of climate change, and our second panel will then, our third panel will then be focused on corporate lobbying and climate change. We thought we wanted to use this middle panel to hear from someone who's actually working in the corporate sector and has insights into how corporations are trying to meet the challenge of reaching net zero emissions. So I'm very happy to welcome our next speaker, Geoff Mackey, who can speak exactly to this issue. So Geoff is currently the Corporate Affairs Sustainability Geoff is currently the Corporate Affairs and Sustainability Director at BASF. This is one of the largest chemical manufacturing companies globally. So Geoff holds a PhD in business administration from Derby, as well as an MBA and an undergraduate degree in biology. And Geoff has worked for BASF for over 20 years in various roles, including in their European Government Affairs unit and as the company's Sustainable Development and Communications Director. In March, BASF pledged to meet net zero greenhouse gas emissions by 2050 and to cut emissions by 2030. This makes BASF one of approximately about 25% of the world's largest corporations that have made such a net zero pledge. So we asked Geoff to tell us a little bit about what led BASF to make this net zero commitment and how the company plans to meet this very ambitious target by 2050. So I think with that, we should be able to turn it over to Geoff, who is sharing his slides. So I think, Geoff, if you're ready to go, I'll turn it over to you.
Kelly,
Yes.
Good morning. Thank you very much.
You're very welcome.
How are you?
I'm very good. How are you? Thanks for coming.
Thank you very much for the invitation to be here. It's always a great pleasure to be asked to speak on such a topic. My brief today is to give a blinding overview for about 20 minutes on where our journey has got us to and some of the challenges along the way. I don't hold ourselves up as a perfect anything. We are trying to find our journey as well. So what I'd like to do is just share from here, and we'll see where we go from there. Or I will do if I can, if I can make the technology work, which is always a pleasure. Okay, from my side of things, within the chemical industry, one of the starting points when we talk about challenges is to understand that as a carbon-based life form, if we start talking about reductions in all sorts of levels, we immediately have all sorts of impacts we have to deal with. And for BASF, it perhaps helps a little bit if I introduce the business for those people who haven't come across BASF. I'm not going to read my slides to you, that I always regard as inappropriate, but I put up a few numbers to give you an idea of what sort of business we are. The reality of our business is we're at the top of most value chains in various ways. Certainly the chemical industry is at the top of all value chains. And we are very, very serious about what we do. As a business, we're structured along a number of segments. We kind of touch everybody's lives every day, whether it's the food they eat, their personal care, nutrition, health, materials, travel, you name it, chemistry is involved in it. The other thing I should say about our business is that we're an R&D business. The reality of our conversation, our processes, products and technologies is it's all about looking to be more sustainable. That's very much part of what we do. I was asked today as part of my brief to mention the challenges along the way. And if you look at the history of BASF, our purpose is we create chemistry for a sustainable future. That's a huge statement to make. And the question of what a sustainable future is a challenge statement, because actually it means different things to different people. It'll mean different things to the people in Glasgow today, some of whom live there and some of whom will be in Glasgow for the first time. The question of sustainability in our society is also part of this conversation. Our corporate commitments, and we're a corporate business, we're a global business. Therefore, you would expect us to be making these statements. However, with all deference to others, we live on these statements. The reality of who we are and what we are is we insist on being leaders. We have looked forward and we have planned, and yes, we have got an overview of what we're doing and how we do it. We also have a very good view of the materiality of what the topics are that mean to our stakeholders and our businesses. And again, the challenge is how to cover all of these, because it's not just a matter of picking these things out on an individual level. It's also a matter of looking at them so that they can actually trend, inform, and enhance our business. The climate protection challenge is not one that anybody can do alone. And that is going to be one of the challenges of the next 2 weeks at COP26. The reality is, well, I think we all are hearing what the reality is. 1.5 degrees has to be the aim. Once you start slipping past that, there are some massive challenges across our globe, and everyone has to play their part. We will be definitely playing our part. Our commitment to 2050 and to net zero 2050. And by the way, we also have to be very clear what we are as a business. We still start our crackers with oil and gas the majority of the time. Therefore, the challenge is to start to reduce our emissions rapidly and get to net zero by 2050. The last panel talked about the challenge of scope 1, 2, and 3. As a science and engineering business, you would expect us to have a pretty good grasp of scope 1 and 2. And the challenge of reporting mechanisms when it comes to scope 3 is indeed things like overlaps, transparency, and people trying to use things for leverage, because that's the other part of the challenge with this. From our side of things, the journey can be broken down into some pretty meaty conversations. First and foremost, look at where our power and our electricity comes from. The reality of the conversation, the reality of our conversation is we need to start by looking at our power sources. Then we also have to look at how we use those within our crackers. We have to have biomass material, and this has to be a continual process. And in the middle, you've got that wonderful phrase, new technology. Do we actually have a clear path to net zero? No, we don't, but we have got a commitment. And the reality of a business like ours is we have 155 years of pretty much hitting the targets we set for ourselves, because that's what we can do. And that's part of the conversation I'd like to gently run through. I'm not going to be very, very dull and go you through line by line, but to break it down, you can see where we are now, you can see where we've come from, and you can see where we're going. Business as usual is not an option. That's a simple full stop. If there's anybody out there, and that's diplomatically, politically, commercially, or any other way, who think that we can continue to do business the way we have done, the answer is we can't. It's not possible. The question of what you do and how you do it becomes part of the conversation. I live in the UK, and I'm always mesmerized that even today, I still hear people arguing about why we should be better insulating buildings. I'm not even prepared to discuss that one further. It mesmerizes me. Greenhouse gases along the value chain is part of this conversation. And if you think about where our business sits at the top of many value chains, the starting point then becomes if we can actually create that pyramid by producing no carbon, then all the downstream from us has a much better chance of actually doing the same thing. And therefore, we believe we have a responsibility along the value chain. That's the position we intend to take. There's a few things that are a challenge. The reality today is there is simply not enough renewable energy available. we need to ensure we have more renewable energy available, and we need to make sure we use it as well as best we can. As we start to move to decarbonising our transport and all parts of our lives, we have to make sure renewable energy is available. Within our technologies, there's a number of things we can look at. Methane pyrolysis, the use of CO2-free hydrogen, and many people have seen the conversations going on around blue and green hydrogen production that are still being argued about. The question of crackers that are electrified using renewable energy is a great starting point. And then the other conversation about using syngas. These are all technology investments and involve businesses like ours giving of our expertise and moving things forward. Our carbon footprint and what we actually do is a project that for us has been running for some years. And it's been a really interesting project for me because I'm neither a chemist or an engineer. And I find what we have done successfully is absolutely staggering in producing the carbon footprint of the BASF portfolio. What I find even more interesting, and it says something about the culture of our business, is that my colleagues are arguing harder and harder about the finer and finer points of some of this. But the reality is we have a pretty impressive grasp of the carbon footprint of what our products do. And actually, we're using this to leverage sales. We're actually going back to our customers and we're sharing this information and saying, if you look at these products, if you look at these products in these ways, this will allow you to do various things that will accelerate movement in the right direction. But part of this conversation requires you to know where you're at. And that doesn't mean greenwash. That means transparent reporting systems. That means systems that are open and understood and frameworks that are agreed. And this was one of the conversations on the last panel. Because from my perspective, I remember when I first got involved deeply in this space about a decade ago, and I started to get regular spreadsheets from customers requiring various things. And time after time, my colleagues would then send them on to my office, and I would ring people up and I would say things like, hello, what question do you think you're asking? And the saddest answer I used to get was, I'm just an intern with a spreadsheet. And that's the worst possible answer, because that just shows process and no thought. And from my side of things, what we have to do is understand that not one of us have all the answers. We are all in this together. I'm a commercial business, therefore I'm duty bound to talk about some of our commercial activities. I don't intend to, but it means I can justify the fact that I've shown the audience the range of some of the things that we do, especially for a business that many of you will never have heard of. The reality of the conversation is there are other options. There are always more sustainable options. And it's up to all of us to better understand the buying decisions we make. For us, there are three areas of focus: circular feedstocks, material cycles, and business models. And again, this is not rocket science, but it says very clearly where we're going and how we're going to get there. The question of circularity is something that has been within our business for an absolute, well, the Germans call it the Verbund. The idea being that nothing is wasted. Everything is brought back in. So one material that comes out of one product then goes back in to be the starting point for the next product. And we have to start to look at how we recover, we recycle, and we simply avoid waste. Because rethinking design and using things properly is a key part of this conversation. There's already been mention on some of the reporting systems in place. As you would expect, we are part of a series of global initiatives to try and look at how best to firm up the value chains. And the other conversation I would again state is we have to better educate the consumer to allow them to understand the buying decisions they are making. You cannot just buy cheap. You have to buy value. Value has to be based on sustainability. The question of feedstocks, the question of renewability, palm oil is worth mentioning just because of the industries we work in. And that's another part of this conversation. It really is. From us, this has been a long-term journey. It's not something we've leapt on in the last moment. And if I even go back further than this within the chemical industry, a long time ago, it even started from health and safety principles. The chemical industry is it can be called the industry of industries because it's where most people start. And you can see where we are today. And again, from my side of things, I'm very happy to take questions on any and all of this. I just can't promise to have all the answers. Thank you.
Great. Thank you very much, Geoff. That's it was really helpful, really interesting to see what BASF is doing. So I'm just I think, as I promised you, I'm going to ask some questions and then we'll take some questions from the audience, if that's okay. So I think maybe the first question then is just to maybe go back to this question about the net zero pledge that BASF made. So I'm correct in saying that, so that was done earlier this year. That's correct, in March, is that right?
Yes, it was.
Okay. And just for clarification, that's a net zero for greenhouse gas emissions and not just CO2. Is that also correct? Because I know there's some differences in how companies define net zero.
Yes, and again, I have to be honest and say I was mesmerized when I read that we did that commitment. Because given that we start the position we do as a business today, I have to think we would ever do it. And I put my hand firmly on my chest and say, I'm very proud to be in a business that has done that. Because we're not a retail business, with all deference to retail businesses. It's quite easy from my seat if you're in retail. The answer is you decarbonize your transport, you look at your packaging, you stick solar panels on the roof, you deal with your footfall, net zero. When you're industrialized, the game is completely different. Yeah. And for us to make a net zero commitment, I think is an amazingly strong statement strategically.
Yeah. And so maybe just to follow up on that, how did that decision come about? I mean, what were the factors that led BASF to make this public commitment? As I said, I think it's about there's about 25%, so maybe about a quarter, maybe it's even just a fifth of the large corporations worldwide who've made such a commitment. So maybe you could just give us a little bit of internal insight, perhaps first into how BASF came to make that commitment, and what do you think are the barriers to the other large corporations making a net zero commitment?
I would suggest that there's an interesting cultural question in there. First and foremost, in any large corporate business, the question of how decisions are made is always part of the challenge, because there's all sorts of influences internally and externally on business decision making. One of the things that no business wants to do is scare the market, and the market doesn't want to be scared positively or negatively. From our side of things, we create chemistry for a sustainable future has been with us for years. Therefore, the market has been warned where we have been going for years. And therefore, by the time we got round to be able to make that commitment, I think whilst it's a very strong commitment to make, the other part of the conversation is we've very openly said that we don't have the pathway. You know, we think we can get there, but we're going to have to develop technology along the way. And that's another part of the conversation, because we're going to have to do that using our expertise and doing what we do very well. I think it's a clear strategic positioner for us as a business as well going forward. And it's kind of one of those awful conversations where you sort of go, somebody stop us, you know, here we go.
So obviously within our first panel, we were looking at investors and corporate reporting and how investors, you know, react to that reporting and demand more reporting. Was this an important part of your decision, do you think? Were investors an important stakeholder in what was going on? You talked about scaring the markets and not scaring the markets, but.
Yeah, I mean, I think at the end of the day, the question of what risk is and what risk isn't is part of this conversation, particularly when we still use economic metrics a lot of the time. The question of non-qualitative measures and all the periphery of what goes on around that is part of it. So from my perspective, the short answer is yes, we're always listening to the different voices as part of the conversation, but we're also looking to lead with what we do. And that's something that certainly our CEO, Martin Brudermüller, has been very clear about. We're looking to continue to lead.
So you'll know, and this is true, the net zero commitments that governments are making, but also that large corporations are making, that there's a net zero commitment for 2050. And then the one for 2030, I mean, to BASF's credit, you do have one for 2030 and many don't. But of course, there's always this kind of, I don't want to use the word skepticism because that's too negative, but questions about, you know, you can make a commitment to net zero by 2050, but how are you going to get there? And I guess, I'm sure that's a question that you've kind of been dealing with a lot in this run up to COP26.
Yeah, I mean, the reality of where we're going to get there, the time scale for a lot of what we do and the investment that it takes, it actually isn't something, you can't just flick a switch and make a 5 billion investment. If you take our largest investment at the moment in Europe, we've just announced it's over $1 billion investment in renewable energy in the North Sea. And the whole point of the exercise, that is preparing our business for actually using more renewable energy. Because the short answer is it's simply not there at the moment. We simply don't have enough renewable energy. Therefore, we're prepared to put our money where our mouth is and say, right, we're investing now in renewable energy for our business to allow us to reduce our carbon.
So as part, and again, kind of linking back to our first channel, this is our first panel, sorry. This is a question that I had in the chat from Yannis. And it goes back to this, this question of challenges in reporting. And what do you see, what have you experienced so far in terms of your reporting challenges, and how do you see that moving on into the future? I mean, I guess we could link this up to the TCFD, which we talked about in the first panel, Scope 3 emission reporting, which you also kind of mentioned there in your talk. But how do you see this going forward in terms of reporting?
I suppose that I'm going to be a little glib, if I may, Kelly.
You may.
I've waited most of my career to become trendy. It would appear I've finally become trendy. It's just a bit bloody late. the reality of the conversation, my first degree an awfully long time ago was as an ecologist. No one is more surprised than me that I've finished up doing what I'm doing within the world's largest chemical technology business. If I go back a decade and I started talking about CO2 and emissions and sustainability, the honest answer was people looked at me like I was a bit weird. You know, I was kind of green tinged in a suit. And the reality of the conversation today, if I say what I do for a living, people are actually interested. So that's point one, if I may. Point two is the whole question, what does sustainability mean? Because the practical problem is it's not going to be an easy road. And the publics, the consuming publics, are going to have to realize that this affects all of us. And I can be talking about some of the work that we're doing with customers on everything from redisposable packaging or bottles or transport systems, because I'm working with all those companies out there that you can think of doing all sorts of really, really interesting projects. But part of the conversation, we also have to look at things like consumption patterns. And people have to better understand their buying decisions. Because the question of whether we need a hot drink or whether we need to get on a plane are challenges we have to make to ourselves individually. And that's another part of this conversation.
Can I draw you out on the scope 3 reporting, just because I know it's of interest to many people in the audience? Is this something that that BASF is thinking of moving to, or is it just too big of a challenge at this point? Or
I think the honest answer is, if I answered by said we're agonizing about,
yeah, okay,
would that help?
Yeah, absolutely.
we are absolutely agonizing about scope 3, yeah, because the challenge of how to take that responsibility on behalf of the value chains, yeah, is very much part of our ethos. And the conversation about people claiming value and people not claiming, it's a really, really challenging area. On a slightly tangential point, one of the things I've been involved with the last few years is carbon literacy training. I don't know if you've come across that or other people have come across that. And that's something we find very useful within our business and also within customers, stakeholders, to allow them to better understand a little bit about the decisions they make. And again, I think we can all learn a little bit more about what we do.
Yeah, this is, by that you mean this is the kind of training that you do along your supply chain, or just more broadly even?
Well, to be awfully honest, we spotted it some years ago and really liked what the Carbon Literacy Trust does. And I'm very unsubtle. I picked up the phone and went, hello, have a chat. So I started to train our own commercial people, right, okay, and then rolled it out internally, then started to roll it out to customers. And it's not for everyone. Some people are not at a stage of grasping this yet. But the answer is we simply provide it. It's all about this should not be a competitive issue. The reality is these should be basic requirements to allow people to operate.
Yeah. Right. So another question from the chat, Geoff, is, and again on reporting, as I told you, there's lots of people with interest in reporting in the audience, but just curious about how BASF deals with the multiple reporting frameworks. Is this something that you find a hindrance or difficult to deal with, and do you see it becoming better? I mean, are there common kind of frameworks and kind of standards that are emerging?
The chemical industry is incredibly regulated in all sorts of sectors and subsectors. Whether you're talking about food, pharma, you know, the reality is that we're an incredibly regulated sector, and we spend a huge amount of administrative time filling in all sorts of things and being transparent about what we do, because I think it's important to set best practice and set the bar high for all sorts of reasons. I think if you, as part of my wrap up in my presentation, I threw in the question of 25, 30 years ago, EHS. And I'm old enough and ugly enough to remember a time where EHS was not part of everyone's business.
Mm.
And today, there's no one in the Western world would even start without having EHS as part of the goals. I look forward in the next decade to be in the same situation when it comes to sustainability metrics, that we have got an agreed framework that people can work to. In the meantime, I think we just take the pain and do the best we can.
Okay. So another question, this one's a little bit different perhaps. So you spoke obviously in part because this is what we asked you to speak about, but about environmental risk, about climate risk. But what is your approach to social risk associated with climate change and your CSR approach more generally? That is obviously, you know, we have these kind of three pillars, the environmental pillar, the economic pillar, and the social pillar. With all of this talk and so much concentration, I think quite rightfully on climate change, but is the social pillar still a part of that? And obviously there's some trade-offs there.
The social pillar has to be there. The challenge is always the balance and the weightings that people choose to put on things. And that's what I also mean about carbon literacy. I used to talk 10, 15 years ago about cut flowers being an unsustainable industry. You know, we were flying cut flowers into the UK for Valentine's Day, and I used to use the example of a dozen wooden roses I had bought my wife when we got married, and I told her it was the last roses she was ever going to get. You know, that was a nice story of its time. The reality today is that we as a society, if we stopped buying cut flowers, there are all sorts of communities in different parts of the world that would be the communities would be in trouble immediately, because that community has been built up around the industry that we have created. And I suppose, as a long-winded answer to your question, it's not very simple. It's an incredibly complex area. And I think we have to take a value to society approach and have a look at the wider aspects of what we do and how we do it, and moderate change. There has to be some sort of management of change process, that we don't just leap into one, because actually what we're leaping into can cause as many problems as what we've left. And we have to be big enough and clever enough to understand that no one has all the answers.
Geoff, I was curious in there, and I don't know if this has to do with the social pillar, but you did highlight, you made a special effort there to highlight the palm oil issue, and I'm just wondering why you saw that as important to highlight here.
I think the palm oil is an interesting one, because again, I'm not exactly target market for a lot of the personal care industry. And one of my challenges over a decade ago, when I started to get involved in this, I turned around to some of our very, very good chemists and went, replace it. Why can't we just get rid of it? And the answer is, there's nothing like it. And the reason is because actually we have to respect our value chains, and those value chains have to be educated. Because again, unfortunately in this world, there is always someone who will try and make the quick buck. And what we have to do is create enough education to ensure people know what buying decision they are making. because if they make unsustainable buying decisions, that helps no one.
So Geoff, we have just five minutes or so left here, but as you know, so you're the middle panel. We've talked quite a bit about reporting, but we're going to go on to talk about lobbying and the lobbying that of public officials, basically, that that corporations do in the climate area. Just as and I know this can be a sensitive issue sometimes for corporations, but just a curious question about at a very general level, how do you see regulation, government regulation, binding regulation, as part of the answer to your net zero journey? How important of a partner is government in this?
What a fabulously loaded question.
I was trying not to make it seem that way.
it almost depends what day you catch me on, what reaction you'll get from me to that question. I think it's necessary to have leadership. I sometimes despair that we will never get leadership from governments because the political cycle is too short.
Yeah.
The reality for business, and I know we talk about agility in business, but for a business like ours that is not virtual, a business like ours is built on real molecules, it's built on real people, on real factories. Our timescales are generational. And therefore, what I'm looking for from governments is I'm looking for people to try and understand our businesses and trying to understand what we're trying to do. And if they disagree with some of that, then come and talk to us. What I don't want governments to be is to be standing over there on the outside, using us as an
If we just, I think you just cut out for a second.
Have I come back?
And you're just back.
Have I come back?
Yeah, if you could maybe just repeat the last 10 seconds or so.
Yeah, the great joy of having technology linked to each other. Sorry.
Works most of the time.
We've done okay so far.
Yeah.
And what I'd really like to ensure is that wonderful conversation between, if you think about the different parts that I believe are key in our society, the idea being that we need education, we need the thinkers, we need education and academia, we need business, and we also need policy. Now, the reality of those three, there has to be that wonderful, I'll use the word tension. Tension is a good thing, but the three need to work together. But everyone needs to understand that we all need each other. And I suppose my concern for COP26 is that at the moment it starts to look like a series of politicians not having agreements in public, where behind the scenes there's an awful lot of businesses trying to do the very best we can to move the pile.
So just on that, then, has BASF made any public statements about what you would like to see come out of COP26 in terms of agreements or specifics or anything of that nature?
No.
Okay. Is that something that companies shy away from doing? And if so, why? I mean, presumably having, regulatory uncertainty is difficult for firms, particularly those with net zero commitments. So
I think the question of regulatory effects can be a good one. I mean, again, if I take the UK, I don't know if you remember, we used to be part of Europe here in the UK.
just and we barely remember that. Yeah.
We went through something called Brexit. We're going to be dealing with friction and one piece of legislation called UK REACH for the next 6 to 8 years. The reality of
this is the big chemical regulation that was part of EU and is now the UK needs to deal with, basically.
And the honest reality is that we are where we are, And we still haven't got clarity on some of this. And that then becomes a barrier to all sorts of things. Therefore, if I was to ask for one thing from policymakers, it's consistency and a sense of time scale.
Okay. And so do you find, though, that that pushing governments on this, maybe, lobbying them for, for particular types of regulation in the climate space, is that something that you find helpful? If you want, I guess there's always this question about, why is it that companies who have very progressive, kind of net zero pledges or climate goals or what have you, why then often we don't see them going to government and getting, regulation that would help move that forward? If you're a net zero company and you have this pledge, and as I said, you're one of the few that have it, could it even be seen in your commercial interest to raise regulation, given that you're already on your way there and some of your competitors perhaps aren't? Again, just trying to get a sense of how you see the role of government in this.
I mean, from our perspective, our advocacy and what we do is part of our dialogue with government and with the regulators. It tends to be an ongoing conversation. I sometimes wish officials would come to us more than we go to them. And there are times I find myself shouting at the television, like I did when I heard the British Prime Minister's comments about plastics and recycling the other day to the group of school children. I'd like to congratulate the Prime Minister on getting me to swear at him on the screen, because I don't know who had briefed him, but frankly, they needed taken to one side and told some straight facts. That is all part of the science literacy and carbon literacy conversation. And from my side of things, we do not hide what we do. We'll talk to anybody about it very openly. We all talk regularly to the politicians and officials in and around our sites and governments, and we're very happy to have those dialogues. The question of whether they're always happy to listen is a secondary conversation.
So, Geoff, we're just about out of time here, but I've got one more question in the chat for you, which is, how does BASF work with stakeholders for educating customers? You've just mentioned it again, this literacy and the importance that everybody is better educated about this. How do you go about that more specifically?
Let me do two very quick things. As regards science literacy, I've actually got 8 schools around Glasgow that we're visiting during the first week of COP26. We're going into the school, science dictionaries, we're talking to the kids about what they can do to change the world and giving them the chance to do that, because that's all part of the science reality going forward. As regards our customers, and I'll assume they have some science literacy, we then talk about carbon literacy, and we actually formally will do carbon literacy courses for the pleasure of them attending them. And this is a one-day certified course, which again, we do as a matter of course. And these are things that we simply do for the market because we believe it's right and proper to do so. Oh, and as regards the science dictionary thing, if anybody hasn't come across the Great Science Share, have a look at that. And the fact that around our sites, we have our own science experiences and we try and have community conversations. But I believe it's all part of any business is to have its voice and help its communities.
Okay. All right. So with that, we've now reached actually 11:16. So thank you very much for this. It's been really helpful, and best of luck to you in the schools and in Glasgow this week. Sounds like great fun. But thanks, Geoff.
I would never call visiting a school fun. They ask the best questions of all. Trust me. Right. Thank you very much for the invitation to be with you today.
We appreciate you being here.
Here's to a good COP.
Yep. We'll all look forward to that. Yeah. Thank you very much, Geoff. So
Thanks,
for everyone Everyone else will take a 15-minute break and we will be back at 11:30.
Hello, everyone. It is an honor and a privilege to chair the last session of today's event. And allow me to briefly introduce the two presenters of the session. Our first presenter is Professor Alberto Alemanno from HEC Paris. And Professor Alemanno is a graduate of Harvard Law School, the College of Europe in Bruges, and he holds a PhD in international law and economics from Broccoli University. He has published widely in the area of corporate political activity and public interest, covering a wide range of issues from food policy to economic and political disparities, from gentle intervention nudge to active and effective lobby for change. Professor Alemanno has been working on enhancing academic and policy engagement in EU, US, and also in East Asia. He has been involved in a dozen of campaigns. I think it's fair to say he is himself an exemplary model of the good lobby. Our second presenter is a good friend and a colleague of mine, Dr. Alvise Favotto. Alvise is a graduate of Ca' Foscari University of Venice, and he completed his PhD study here in Glasgow. Alvise has a strong research interest in corporate political activity and social responsibilities. He is later going to share with us from his recent project with Professor Kollman on corporate sustainability and climate and lobbying. So allow me to hand over to our first presenter. Welcome, Professor Alemanno.
Thank you so much, and nice to be with you today. I just wait for the authorization to be able to share my screen. For whatever reason, I'm no longer able to do so. Yes, it's happening now. Perfect timing. Thank you so much. You should be able to see my screen now. So as you said, I will try to open this third and last panel of the day by sharing a few reflections based on my academic research, but also on my action research, very much linked to the organization called The Good Lobby, that I have established a few years ago with the objective to equalize access to power through basically two activities. One is to make corporate lobbying more sustainable, and I will explain what I mean by that, and at the same time also enhancing the advocacy capacity of civil society that oftentimes struggles to get the same access to decision making. So all what I will be saying is based on a combination of research work and practical action research done with a variety of actors, some of them very unconventional, including a few philanthropies and some benefit corporations that have also been part of our privilege observatory over the last few years. So the problem that I would like to frame with you is this idea that businesses are increasingly taking responsibility, or at least they are made responsible with the new regulatory packages for their impact on the planet, for their impact on society and the communities they rely on. There's one impact that is still not fully internalized. And by that, I mean the democracy footprint that corporations do have. They continue to produce and to live around in the most unthinkable locations, but it remains a footprint we do not often see. It remains somehow invisible. Why this is a problem? Well, it is a problem because corporate lobbying and also other forms that we're going to be seeing together of corporate political power, they tend to shape public policy, and oftentimes they do undermine it. This is certainly the case in the climate change conversation. And this is certainly raising a broader issue. The exercise of corporate political power, including lobbying, is a legitimate activity. It's part of the license to operate of these corporations. But what are the democratic responsibilities that they do come with the exercise of such a power? This is not a question we often ask, but I think time has come to really try to address this question and trying to see what is the kind of a price that companies should pay in order to maintain the license to operate when it comes to their engagement with policymakers. As you can see, this is a different way of framing the policy conversation we are having when it comes to corporate political power, but I think is needed today. Why so? Well, as it has already been mentioned at the very beginning of our conversation, today the opposition from special interest group to climate change and to climate change action is certainly the most important obstacle to advancing our policy action in our conversation. The work that has been done by Kelly and by Alvise over the last few years clearly show a phenomenon they have defined of decoupling, this idea that companies very often do say things, in particular in their CSR reporting, that are very different from what they advocate for. A clear example back from 2015, when the US Trump administration was about to leave the Paris Agreement, or at least considering to leave the Paris Agreement. You could see all these brands publishing in major newspapers across the US this announcement saying that they wanted the Trump administration to stay in the Paris Agreement while being members of one or more trade associations. They were actually actively trying to actually get exactly the opposite result, which was to have the Trump administration leaving the Paris Agreement. There have been a lot of headlines at the time, and the work by Influence Map has been extremely powerful in suggesting how systemic this decoupling is occurring today. These are the companies with the largest network of industry associations which are opposing climate. So the game is trying to see to what extent Shell or BP or Chevron are actually saying in their CSR, they're actually saying to be pretty much aligned in their climate change action, but in reality, they continue to be a member of, in this case, more than 20 trade associations that pursue exactly the opposite objective. The Influence Map, this very interesting organization based across regions of the world, today has compiled the world leading database of corporate lobbying on climate policy, and you can see that approximately 10% are the companies whose lobbying activities seems to be aligned with the Paris Agreement. This is happening across policy fields. When you look at the corporate sustainability governance package in Europe, you see major disalignment between some big companies like Mondelez, Unilever, and Ericsson from their major trade association, which is Business Europe. So this is happening more and more across policy areas, not only in the climate field. And this is a problem for a variety of perspectives. There's certainly a reputational one, which might be the one that is already pushing some companies to somehow align their CSR with their corporate political conduct. But there's also a greater one, which is the financial one, which is coming from the ESG, in particular from the G letter, which however remain quite underdeveloped, as we will see. It comes from the market. Possibly some customers might realize that there is some misalignment and therefore their consumer behavior might change. I have a couple of students now at my university actually looking at the relationship and in particular at the willingness to pay for products and services coming from a corporate political responsible company versus one that is not. And then there is the broader public policy issue of how we can get this right. And this is my perspective today. What kind of public policy do we need in order to make such an alignment happen? There's also a societal problem. We see more and more studies suggesting that if companies, instead of simply focusing on their greening efforts at the individual level, they would actually be focusing on contributing more into their own advocacy, as Kelly was pushing the BASF representative a few minutes ago. Well, their contribution would certainly be greater than just their greening or their, let's say, internalizing the different social costs. So what is the bottom line? The bottom line today is that corporate political conduct in its variety of activities represent the major obstacle towards progress across policy fields, not only in climate, and here I gave a few examples. So it really represents a systemic issue towards change. So how can we address it? When you look at the state of the art on lobbying regulation, you can clearly see that over the last few years, we witnessed the emergence of more and more regulatory framework asking for major disclosure requirements, imposing disclosure requirements on a variety of companies, which tends to give, at least make somehow observable the exercise of some forms of corporate political activity, which basically boil down into meetings between decision makers and corporate political and corporate representatives. We have some very interesting framework, a bit more advanced, like the French one or the Irish one. But the bottom line is that we're talking about disclosure requirements, which basically ask the lobbyist, so the lobbying side, to disclose how much money they are investing in one particular year in this activity. So there's a lack of granularity in the way in which these obligations are imposed. And they oftentimes, besides a few exceptions, like now partly the European Union and partly, I would say, Ireland and possibly France, you can see that most of the obligations are just on the corporation side, on the lobbying side. They're not on the other side. But lobbying is a bit like tango. You need two actors, and the fact of completely omitting obligations and disclosure obligations on the policymakers and the politician side is somehow making the lobbying regulation under-compassing, and in particular inadequate to actually capture the variety of the expressions of corporate political power. And here I really think about a variety of activities. You can see here the idea of disclosing your membership to a trade association, the idea of disclosing your political donations, the idea of disclosing how many of your employees are sitting in expert panels across governments, across Europe and the world. What kind of academic research you as a corporation you are disclosing, you should be obliged to disclose. What about think tank memberships, which are also very often an obstacle to exercise political influence? What about astroturfing? What about third-party support? And finally, what about philanthropic donations? So this brief taxonomy of different forms of corporate political activity, they clearly show how inadequate our lobbying regulations are, because they are simply not getting there. They're not capturing all these forms of expression. There is some interesting development on another approach, which is somehow complementary and partly building upon the existing corporate regulations, which is represented by non-financial disclosure, rating agency asking companies, because of the pressure of investors, about the political engagement they do have, how they organize it. And very often time, if you look at Biagio Iris, if you look at GRI, you can really see that these surveys, they try, or they tend to go beyond what the mandatory requirements are actually imposing. So you see public policy being already overcome by third-party actors like rating agency of these sorts in the sustainability field. However, also in this case, we see that the focus is merely on lobbying, is not very granular, the kind of reporting, is major amount, is the aggregate amount. So the bottom line is that no mechanism today really tell us how much a company is exercising its political power in the public policy field. We don't have this information. All this is not observable. We don't have the democracy footprint of companies, not even the most progressive ones. And this leads us to the third approach, which is emerging. There's a small ecosystem of actors. If you think about the responsible lobbying framework developed originally by the Melinda and Bill Gates Foundation in one specific market, which is baby formulas, but then being extended now across policy fields. And the same OECD trying to envisaging for the first time to develop responsible lobbying principles that would be addressed to companies and not to states. In the past, OECD has been developing these lobbying principles. There is a revision, there's a new report that has just been published, but there is this ongoing conversation on whether also the OECD should actually develop this kind of checklist in order to allow companies to actually fill the gap between what the lobbying regulations say and what the expectations from the market, from the consumers, and from society are. An example that I think is very concrete and tangible is the effort made by the B team, the CEO-led organization that has tried to provide a checklist addressing the specific issue of decoupling when it comes to companies and the trade association and their lobbying activity. Here you can see a suggested course of action. There is a group of actors that are really experimenting this approach and trying to become more refined, again, in being proactive in the way in which they handle this kind of misalignment. This is an example coming from the B team blueprint, what kind of letter a company should send to a trade association when this trade association is not satisfying its demand for making distinguishing, for somehow nuancing and the position of all its members. And you know, there's a major broader conversation about the crisis of the traditional model of trade association not being able to do justice to the different positions of their own members. The hypothesis upon which I've been working at the Good Lobby with my team, and I think is partly shared by this small ecosystem of people, researchers, actors active in the responsible lobbying space, is that if we push and we make more observable the political conduct of corporations, this might lead them to somehow reassess their political engagement, possibly leaving some membership from trade association, possibly becoming much more proactive in their disclosure, much more granular, much more attentive to the way in which they exercise their political power. So this is an important hypothesis. Obviously, we lack a counterfactual because we don't have enough good scholars, corporations that actually have been able to do so, and they have shown that this actually is making a difference. But we already have some signs and some interesting models suggesting that this might actually work. So the claim I would like to make today at the very end of this short presentation is this need to attempt to frame the exercise of corporate political activities into the broader corporate sustainability strategy that partly regulators and partly companies are developing themselves. So instead of simply talking about responsible lobbying, which is something that evokes a very strong moral duty of companies to actually exercise democratic activities like lobbying in a way which is public, which is accountable, but moving away from this moral understanding to a broader, more holistic one, which is linked to the sustainability agenda. At the end of the day, sustainability is about intergenerational well-being. That means that companies should be equally responsible and therefore sustainable when they actually engage with political leaders. What does it entail for a company to become responsible and in particular sustainable in the exercise of corporate political power? Well, this idea is really about framing in a much more detailed way the obligations, or at least if these are going to be voluntary obligations in the sense that the company will self-impose this obligation, we can think about going beyond lobby compliance, a bit in the way in which non-financial reporting is asking some companies to go beyond simply ticking the boxes of disclosure requirements. We can imagine a proactive alignment with company disclosing by default or the lobbying position, or their specific corporate political strategies when they start occupying a field. We can think about disclosing all the membership. We can think about also making this full disclosure of chairs that are paid, research funding, which are paid, think tank membership. All of these might happen. And the final point, which I think is the most original one, is this idea that the most progressive and sustainable companies should also be proactive in the way in which they ensure equal access to power. In other words, they should actually make their exercise of the corporate political power conditional upon giving equal access to other interests in the particular policy conversation. In other words, the world in which the Good Lobby would like to live in is a world in which certain companies would refrain from engaging with policymakers unless other interests are not represented around the table. This may sound idealistic, and certainly partly is, but it's also a direction where I see some benefit corporations, some progressive companies willing to go. How to do so? Well, there are some policy ideas that have been circulating, that I've been also writing upon, the idea of a civic time off, something that is very common in the Silicon Valley, where you have companies allowing their employees to take a day off, not only for going to vote, but also to engage with their own, let's say, communities, with their own nonprofit and civil society organizations in order to increase the engagement and also the policy engagement from the bottom up. We can think about lobbying aid. We all know what legal aid is. When you cannot afford a lawyer, but you need to go before a court, well, the state is going to cover by default a legal service paid to you. We could imagine to do the same with a lobbying aid. So organizations that they do not have the resources to advocate and to engage with policymakers, they cannot run an impact assessment to question the studies made by a corporation, might actually receive public funding in order to equalize access to power. So this is an idea of political equality, which is substantive in nature, as opposed to be simply formal. We should no longer accept this default idea, which is basically that everyone has the same access to policymaker. This is simply not true, and we have plenty of evidence that this is actually not the case. And therefore, we need to have both the state and the corporations playing an active role in empowering all interests to be represented before decision makers, before a decision can be taken in a legitimate way. So this is the idea of sustainability in the exercise of corporate political power that I wanted to share with you. Thank you so much for your attention, and really looking forward to your reactions and to the next presentation. Thank you, and back to you, Minmin.
Thank you, Professor. I think we'll take questions at the end. So yeah, welcome our second presenter, Alvise. Hand over to you.
Hello everyone. Just let me share my screen, and we start from there. So see whether that works. Yeah. Okay. Can I just confirm you can see my screen, Minmin? Yeah, good. Thanks, Alberto. So, good afternoon, everyone. Thank you very much for the opportunity.
Do you mind enlarge the slides, because it's you can only see them in the middle bit. You make it full screen if possible.
It is full screen apparently. Okay, let me stop sharing and let's try again. Okay. Open that. Okay, let's try a different one. Just sorry for that. Okay, share this. Okay, can you see this? Oh, thanks, Mimi. So, as I said, good afternoon. Thank you very much for the opportunity to present today. What I'm going to present is some of the results of a research project in which I've been involved with Kelly Kollman, who you met earlier on today, and Fraser Macmillan, who is again in political science at the University of Glasgow. Now, the project really looks into the relationship between CSR programs and policies an organization might have and their lobbying activity. And the results I'm going to present today are mainly in relation to lobbying for climate change. So the starting point is very much where some of the other presenters today have been discussing. So two types of pressures companies have been kind of exposed to in recent years. Number one, a pressure for being responsible actors, both in terms of their social and environmental impacts. And number two, as Alberto was just mentioning, there is more scrutiny around the lobbying activities of business and corporations. There are calls for this lobbying to be more transparent, but also less instrumental, so more directed towards the public good instead of possibly satisfying mere business interest. Now, these two pressures, social responsibility and lobbying and transparency in lobbying, have been growing and developing somehow in isolation. And if you look at research looking into CSR disclosure, for instance, what you find is not many companies would kind of include information on their lobbying activities in areas such as climate change, human rights, or environmental impacts. So at the same time, this lack of transparency in lobbying has exposed companies to accusations of CSR washing. Why is that? Because there is deep down the suspect, and perhaps it's sometimes even more than a suspect, as Alberto was saying a couple of minutes ago, that a company can basically adhere to very virtuous CSR standards and have a very ambitious CSR policies, but you know what, like from the back door kind of lobby for deregulation and like easier targets for their environmental and social impact. So what we try to do in this project, Kelly, Fraser and I, is really try to look at two questions. Number one, to what extent the CSR activities a firm has in place shape the access this firm has to policymakers, and we look at that in the context of the UK, and perhaps more importantly, to what extent firms with higher CSR credential would engage in more responsible lobbying. And I'm going to touch upon this second question in the presentation today, especially in relation to lobbying on climate change issues. Now, when I mention responsible lobbying, what we had in mind is really three major issues. Number one, is this lobbying something that is aligned to the goals and the objectives of corporate sustainability as manifested, for instance, by the UN SDGs? Number two, is this lobbying offering evidence and information to policymakers that can help them kind of tackling those goals and those sustainability ambitions? And as we have seen in the presentation by Geoff earlier on, companies are almost have very big sources of information, and at the same time they are like the best placed to know and have expertise on certain problems. And third, going back to what Alberto was just saying, is this lobbying, is this responsible lobbying, a lobbying that like fosters dialogue between the company and state regulators in order to hinder and diminish some of the negative impacts market activity may generate? So I'm going to show like some of the results of the study in a second. What we did was to basically track the political access firms belonging to the FTSE 350 in the UK add to policymakers across two parliamentary sessions between the 2010 and 2017. For all those companies, we track their testimony, and we look especially at two parliamentary committees, the one on energy, climate change, and the other one is the one called environmental audit. So for the presentation, we are going to divide companies in high CSR and low CSR. High CSR have better CSR credential as tracked by by ESG rankings, while low CSR companies have less of those credentials. So just to give you an overview of the evidence we gathered here, you see like some results on the information these companies provide to policymakers. As you can see, ICSR companies, those at the left-hand side, would use and refer to information from their CSR programs in 43% of the statements they make in front of politicians. So they would refer to their CSR programs quite substantially, while low CSR companies, those at the right-hand side of the slide, would do that in less than 1 in 3 of their statements. Now, but what political positions do these companies take when it comes to climate change and environmental issues? Now, if we look into our policy positions, what you can see here is that ICSR companies, the dark blue bars, are more prepared to discuss their policy position in all the policy items we've been considering, being that government policy, regulation, resource provision and taxation, or even self-regulation. At the same time, we see a major kind of difference between ICSR and low CSR companies when it comes like the discussion of current government policy and opportunities for regulation. Another important aspect here is if you look at like self-regulation, we don't find much scope and many statements regarding self-regulation on any of from any of the two groups, and that's quite interesting. I will come to back to that in a second. Now, if we zoom in and we look into like the positions these companies take when it comes to current government policy and regulation, what you find is that ICSR companies are more likely to support the government policy and the government stance on regulation. And by looking at the statements, we see that about 63% of those statements are supportive in those first two bars at the top of the table. When it comes to low CSR companies, what we find is that like that support is not there as much as it is for higher CSR counterparts. And in the vast majority of the evidence shows that basically like opinions or statements that are mixed or against government policy and government regulation are predominant here. Now, how do these companies justify their positions? Now, what you see here is a stark difference in terms of the range of justifications ICSR companies mobilize when it comes to justifying their position. Of course, there is a predominance of business interest type of justification, which you can see at the left-hand side of the table. But what is really interesting for us is that companies, ICSR companies, are more prepared to discuss the effectiveness of a given policy, which is debated with the policymakers. And here we really see the sharpest difference with the low CSR companies, which do not make many statements around that. Now, this is also reinforced by the style of the deliberation of these two groups of companies. Here you can see that ICSR companies are likely to answer policymakers with sophisticated statements, looking at like questions in details and from a number of perspectives, while low CSR companies are more likely to produce evasive or pushback statements in which they really try to dodge the ball which is thrown at them by policymakers in these testimonies. Now, and just to conclude, some idea on stakeholders, as Alberto was mentioning earlier on. Now, what we see here is that, like, when we ask what stakeholders are mentioned in these testimonies, what we find is that there is a predominance of market stakeholders, customers, other market actors such as suppliers, business partners, etc. At the same time, of course, almost understandably, there is a lot of reference to policymakers and policy actors, given the type of the that is not really surprising. What is surprising though is that like other key stakeholders that feature prominently in the CSR disclosure of these companies, such as the civil society, NGOs, the community, employees, etc., they really don't feature much in these testimonies. So to conclude, what we find in this report is that basically ICSR companies, as companies with better CSR credential, lobby politicians in ways that are a bit more in line with the commitments and the objectives of corporate sustainability as manifested, for instance, in the SDGs. We find also that there is rarely or almost absent reference to self-regulation in the testimony, not only of ICSR companies, but of also lower counterparts. And that is perhaps against a little bit some of the conventional wisdom around CSR washing being pushed via kind of calls for self-regulation. Picture is so far is quite nice. It's not the rosiest in a sense, because even for ICSR companies, what we find is that those fall quite short on some standard definition of responsible lobbying. First, we find that when it comes to supporting more stronger regulation or climate change, this is very limited, and it remains substantially muted even for very ICSR organizations. At the same time, what we find is a lot of justification or companies provide for their position is very much framed around mere business interest. It's not a conversation on public good they have in there. And again, this is also reinforced to the type of dialogue they seem to engage with policymakers. And that dialogue, yes, it includes some market actors, but it doesn't go very much very far from there, in a sense that it doesn't look, for instance, to civil society and the like. And just to conclude, and just to possibly reinforce what Alberto was saying a couple of minutes ago, what we find is that, of course, there are clear links between CSR performance and lobbying activities this company put in place. Now, this to us is a problem not only of guaranteeing transparency on lobbying activities, but really it is a problem of pushing accountability on those activities, on those positions companies advocate for. And so here, we humbly kind of suggest that this can be tackled both from a soft law perspective by, for instance, pushing and kind of expanding on the work that some multi-stakeholder initiatives have already done in terms of including and asking for lobbying disclosure as part of CSR reporting, and the GRI, as Alberto was saying, is a case in point. But of course, we want this type of standards to be a bit less detached to mere transparency. Transparency seems to be a very good starting point, but really what you want is accountability and justification on position and on policy choices. And this, of course, can also be fostered and pushed via harder regulation, and that could be another solution. This is all for me for today. I thank you very much again for the opportunity to present, and looking forward to any questions you might have.
Thanks, Alvise, and thanks, Professor Alemanno. So both a very interesting and inspirational presentation. And there's already a question for you from Diogenis. Have you witnessed any lobbying activity from company from experience? And do we see any interest from other lobbying group? Questions.
Okay, we perhaps let Alberto go first, and then just to follow the order. I don't know.
Yes, I was reading the question in the chat. Well, I think Diogenis is a great question. What I see emerging is a niche sector, a niche ecosystem of actors that are very interested in holding corporations more accountable in the way in which they exercise corporate political power. And I see some of these actors working, accompanying some companies that today realize that at the end of the day, even if they are well-intentioned, meaning that they want to exercise corporate political power in full transparency, by ticking all the boxes of regulation and filling up all the non-financial reporting, this is still not enough vis-a-vis their customers, vis-a-vis their investors, and they would like to go further. So I see that there is an incipient demand for companies to be rewarded for actually doing better than the others, but they don't know exactly where to go to get such a label, whether this should be by filling up more non-financial reporting, so this kind of multi-stakeholder initiative, whether it should be about self-imposing checklists like the one of responsible lobbying I mentioned, developed by Meridian on the base of the Gates Foundation. They don't know where to go. And I think there's hope because it shows that there is a trend from the bottom up of companies not only willing to appear more responsible when lobbying, but actually ready to restructure the way in which they frame their corporate political activity, the way in which they exercise it, and their willingness to be much more transparent, much more accountable. I think this is happening, but it's small. I don't know whether it's enough to get this, to trigger a major systemic change. And the very same companies, as we witnessed today with BASF, are companies that are very virtuous when it comes to their supply chain, when it comes to their sustainability strategy. But when we ask them and we push them to actually make such a shift from lobbying that push for their interest of their bottom line to lobbying that push for the issue, that means supporting systemic change, where these companies become very shy and they don't really go the old way. So once more, they're moving out of their self-interest, but not necessarily because they want to use their corporate political power to advance the issue. So there's a bit of an inconsistency there. There's a bit of a tension, at least, that I feel when discussing to the most progressive companies willing to do more on their lobbying activity.
For my part, I very much agree with what Alberto was saying, actually. But what I would also add is from the study we've been conducting, what you see in those basically in those testimonies is that there is very kind of, and possibly this is practice from policymakers, but there is very limited dialogue across kind of multiple stakeholders. So you see committees and testimonies of groups of organization on a specific matter. You see much less or thematic discussions around a particular issue in which a company would perhaps be sitting in a dialogue with other stakeholders, so like unions, for instance, or I don't know, representatives of the civil society. That happens far less at Westminster. I have to say we conducted some research at the Scottish Parliament, Holyrood, and this is a bit more of like evident in there, and I think that is perhaps a very practical starting point for engaging and asking for, like for civil society, for instance, to have a room for kind of ask for more transparency and kind of ask these companies to be accountable for like their own operations and the impact on those operations might have for environment and social issues.
And we have another question for Alberto, so it's from Kelly. So Kelly wants to ask, are we relying too much on transparency to regulate corporate lobbying? So you mentioned in your presentation, you think Ireland can be seen as a model. And so can you share us a bit more about the Irish regulation, and does Irish law also rely primarily on transparency?
So I will, I mean, I'm not a legal expert, so but like I can say something about like what we see as when we look into CSR reports and testimonies. Well, a lot of like practice is around being transparent, but not being transparent on anything, but on transparent on specific issues. Now, specific issues would be like meetings, like a date and time, and who meets who, like representatives of policymakers and representatives of business. Campaign financing, that is there in many jurisdictions, and so you would have a sense of like what funding goes into what lobbying activity. That doesn't tell us much about what is really the kind of the position a company is going to take on specific issues, why that position is taken. Deep down, like this form of transparency, I think may risk, I'm not saying that it does, but may risk to de-responsibilize like or kind of companies, because in a sense we're relying on some information which is yes relevant, but that doesn't tell us much about corporate political behavior when it comes to specific issues such as climate change, and we are all concerned about that. So in a sense, I think transparency, and perhaps this is a bit shared by others, transparency is a really great starting point for kind of basically enhancing dialogue on such issues, and perhaps enhancing congruence between CSR behavior and corporate political activity. But at the same time, transparency as such is not enough, and really we want a shift towards taking responsibility for positions and actions.
Professor Alemanno, anything to add? Because
yes,
it's actually a question for you.
Yeah, I tend to agree. I think for too long we expected transparency alone to make it observable, the entire impact of corporate political power. But this is a bit of an illusion we have been falling into, because at the end of the day, as I try to show you today, when we look at the many forms of corporate political activity, it won't be possible to actually capture all of them. So lobbying is the tip of an iceberg. Below the sea level, we have an entire advocacy landscape which is shaped by a multitude of behaviors. And unless we make all these behaviors under an obligation of mandatory disclosure, we're not going to get the full picture. We're going to get the whole ocean. And even if we do, at the end of the day, we're simply asking, as Alvise was hinting at asking companies to say what they're doing, but not asking them to actually be concerned about the effect of those actions and trying to be proactive in offsetting the undue influence that they will continue to exercise. In other words, there are structural issues here of unbalance of power that we are not going to be able to solve by simply making them observable. But having said so, as I try to show in this kind of hypothesis, I really think that if we will manage to make more observable the exercise of corporate political activity across the various conduct, this will certainly trigger some reactions, because companies will no longer be able to afford to look as exercising such an undue influence vis-a-vis the consumers, vis-a-vis the investors, vis-a-vis a variety of actors who will simply find it no longer tolerable. And this will certainly change internally within those companies the very same attitude they had for too long, while all of a sudden this democracy footprint will be visible and they might be shamed about this. There will be a lot of naming, there will be some shaming as a result of this. And this, I think, is the scenario in which we need to find ourselves in the future, where both self-imposed conducts, but also some public policy restrictions in the same we both wish with our papers, might actually push those corporations to not only think about being more transparency, but actually being more accountable vis-a-vis a variety of actors. This Copernican revolution hasn't occurred yet, but again, we see signs suggesting that it might soon happen.
Yeah.
Another question for both speakers. Is there any double standard in lobbying for developing countries? So, for example, and palm oil export is being banned by the EU, but at the same time, I think there are complaints about buying on nickel ore export. So, is there any double standard that you're actually dealing with?
So, I'm not sure what you mean by double standard there, but I'll try to give an answer based on what we've seen in the research. Now, in terms of access to UK policymakers, you definitely are looking at a phenomenon that is somehow limited to a kind of a set of organizations and corporations, which is very much a subset of our FTSE 350 group. So we were expecting quite a lot of kind of engagement for all of those FTSE 350 companies. In reality, those who get access to policymakers kind of regularly are a very small subset of that. I would say around about 15 to 25% of the companies we have been kind of consulting and we've been tracking. So in a sense, I think in part there is a matter of who engages in these type of conversations. It can be that some companies do not kind of give testimony or do not meet politicians on their own, but they do it through their trade associations. But really, in terms of when we think about double standards and and this type of arrangement, really for me the starting point is who is involved in these conversations, who shapes these conversations. And of course, if you take a complex problem, there might be an interest of having multiple point of views and multiple parties, and that might be something to think about when it comes to thinking about the case you were mentioning. So I don't have an answer, a strict answer on the double standard there, but I'm sure what I would start from is trying to reflect on who is involved in this conversation, and perhaps it's just a subset of the interested parties in a sense.
Professor Alemanno, anything to comment on?
Nothing to add.
Okay, so I think we're down to the last question. So again, is about any observation or example you can share. So is there any evidence that lobbyists are in favor of specific reporting standard? For example, GRI or integrated reporting over others? Is there any preference we see in practice?
I can share my experience based on a few interviews I've been running recently on the question of non-financial reporting and these different standards. I think most of the public affairs people working in those companies, they feel quite overwhelmed. If you put yourself into the shoes, they need to comply with the law, they need to comply with the lobbying regulation. At the same time, they need to provide a subset of information, which oftentimes is more granular, in order to satisfy these non-financial reporting and standards. So for them, it's all extra work, and it's not really a choice either or. And when it comes to the non-financial reports standards, well, they don't have a choice. They basically need to tick all the boxes and to do all of those. I think the more granular these surveys, these questions are, the more work they create for them. But they also see value in doing so, and that's why they're actually doing it. So I think a very interesting question will rather be what influence these stricter third-party standards are going to have on the public policy of lobbying regulations. To what extent these stricter requirements will then be codified into the law, because companies, most of the big companies at least, will be able to provide those subset of answer. And by the way, this is not a detail, because the information companies do provide to GRI are not public, whereas those they do provide to governments, they are. So this is a key issue where we might see some cross-fertilization in the nature of question asked by the non-financial reporting standards and in the one posed by governments. I see this happening at the French level. So I work a lot with the HATVP, which is the Haute Autorité pour la Vie Publique, which is basically the integrity standards. And they're telling me that they face the competition because, again, what they're asking companies to report is much less than what the companies are actually reporting to third-party entities, which are basically making a business out of this set of information. So this is really a key issue, I think, which remains a bit overlooked.
Just to add to that, I fully agree with what Alberto was saying. I think just a tiny element there is somehow where in space, like these kind of lobbying demands are located within those ratings and within those and in those kind of reporting schemes. So in a sense, I mean, if you we take a very nice and simple kind of ESG scheme like the FTSE for Good, for instance, like demands or questions around lobbying would be featured in the governance side. Now, of course, it makes sense because it has to do with basically no-market strategy, and perhaps it is there as an element of governance. At the same time, there is a risk, at least in my view, that this kind of silos the conversation in a sense that, like, if you're treating lobbying just as, or treating lobbying information as a governance issue, you're not kind of making that link with environmental issues, with social issues, with human rights issues that those indexes aim to kind of tackle. So in a sense, it's a matter of what information is asked, but also it's a matter of how we can establish a link between different types of information rankings or kind of multi-stakeholder initiatives are asking.
Thanks a lot for your answers. I think before we end the session, I'll just hand over to Yannis for any closing remarks. Yannis?
Hello, hello everyone. And again, I want to thank all the speakers for contributing to this event today, and also the participants for their interesting questions. I hope you found it helpful and constructive. So we really appreciate your contributions, both speakers and attendees, and we hope to see you again soon in other events that we will run. Thank you very much. If you need anything else, just email me, Kelly, or Alvise. Thank you very much. Okay, bye.